Again, that gas is on everybody's mind, too. That's basically at $9 right now.
Yeah, again, in the portfolio and constructing it, I view it as a hedge. If things are going to go wrong, if Chairman Powell and the Federal Reserve are going to be continuing to raise rates and not be able to combat inflation, the reason is going to be because energy prices remain stubbornly high. So I think you have to carry energy at a little bit more of an overweight than what's in the S&P right now. So approaching 10% is the right allocation, I believe, and that's where I'm sitting. We're also moving.
Well, approaching 10%. All right. So that's more than right. Isn't that about double? About double?
Yeah, it's about double what the S&P is. So I'm sitting right now at about 10% in terms of a sector weighting to energy. I think that's the right thing to do, just kind of hedging out what can be going wrong here as we move into the fall and as we move into the winter, and we're not really able to affect barrels of supply. So, this is the third consecutive month that we've seen oil now down. I welcome that, but it hasn't done much to improve the overall financial environment, has it?
You think energy and tech can go up at the same time? Remember, there was this point.
I think there's an inverse correlation. I think that's been in effect since the better part of the beginning of July. I've said that on air. I think a lot of times you have to think about flows of capital. And when energy's going up, we're seeing that there are significant inflows into energy. Where's that coming from? It's coming from technology.
Well,
when energy moves lower, we saw that a couple of weeks ago.
I didn't expect you to answer it that way. Because how can you make a big play on mega cap tech and at the same time then make a big call on energy? If you just said yourself there's an inverse correlation between the two, and that's sort of what I was alluding to.
Because I don't
that's been proven out in the market.
They're not going to work at the same time. I said that energy in my portfolio is a hedge. It's a hedge against everything going wrong. So if you think about the month of August, right, I was happy to have energy in my portfolio because energy was the one sector that was higher. I think fundamentally everything points towards higher prices for energy. But the real reason it's in the portfolio is because it's hedging against if something goes wrong. So, no, I don't think energy and technology are going to work in concert in my portfolio at the same time. And I think August was indicative of that when energy equities were really, besides utilities, the only sector that were higher.
But that's exactly where I was going. Shannon, you own EOG and Valero.
Yeah, don't own enough energy, though, for sure, Scott. So, I don't disagree with Joe, and we have a pretty hefty technology exposure in our portfolios. So we're lighter here in energy. I think that this is an area that if you have a very constructive view, to Joe's point, you can get really overweight to the benchmark because the benchmark weighting is really low. I personally would love to see oil come down a little bit from a consumer perspective. I do think that over time, though, for the next several years, we are going to be undersupplied in the energy market. And so if there is some demand destruction here from an energy perspective, and we do see a sell-off in some of these energy names, it could be an opportunity, an increasingly attractive opportunity to take advantage of the undersupply. I wouldn't do that in a refiner. I mean, I think there's going to be an opportunity to perhaps rotate back to some of the integrateds. Right now, I'm looking for that higher beta play to the energy market because I am somewhat underweight. And so I've done that through our refiner exposure, but I think there could be an opportunity to rotate back. The other thing that I would say, Scott, is that the overhang on the energy sector, the narrative around energy and the need to invest in energy infrastructure has really changed in the last 18 months. I think that's going to continue, and that could be a driver as well in some of the secondary or tertiary industries.
Jimmy, Kinder and Transocean.
And ExxonMobil, which is sort of playing all ends in the middle of the risk spectrum and the beta to oil. Transocean is highly risky, but if these day rates continue to go up on oil rigs, it's going to be many multiples of its current share price. That said, upside down balance sheet. So, folks, again, don't go rushing into Transocean. You need to do your homework on this one. ExxonMobil, middle of the road. It's just wherever energy goes in general, you're going to be good. And Kinder Morgan is a steady Eddie dividend play. But I want to riff off of what Shannon and Joe have said here. This is a classic short-term versus long-term. Short-term, you've got a few factors going on here. You got the still lingering COVID shutdowns in China demand being low. On the other hand, you want to talk about things not being believed. Clearly, the market does not believe that the European European Union will follow through on sanctions that will remove any demand for Russian oil barrels at the end of the year. It just clearly doesn't believe that, because if that comes to play, the stark supply-demand imbalance is going to push energy prices probably back up to the highs of February.
Okay.